Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 285 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. So good morning, Matt.
Morning, Mark. Nice and balmy here in the teens, I believe we now have.
It feels like a heat wave compared to the past 2 days.
It does feel like a heat wave.
Negatives in the morning. My toes are still frozen. For whatever reason, I have bad circulation in my extremities, so my fingers and toes are naturally always cold, but the past couple days have been pretty rough.
Yeah, they have. Well, I think it's supposed to warm up. Hopefully this is past us, and I know some of our listeners down south, they're getting snow.
Snow in Florida. That was weird, seeing snow like on a beach where you like couldn't see the sand.
It's crazy. I was talking to my mother-in-law who grew up in Florida. She goes, the last time she can remember a similar event was in the mid-'70s.
Wow, it's a long time ago.
Yeah.
Long time ago. As always, we will quickly review the month-to-date and year-to-date performance, which obviously is the same for January of the major market indices that we track. This data is from Y-Charts and as of the market close on January 22nd.
All right.
S&P 500 index up 3.5% so far for the year. Dow Jones Industrial Average up 3.8%. Nasdaq Composite Index up 3.6%. The Russell 2000 Small Cap Index up 3.3%. And the Vanguard All World Ex United States ETF up 2.5% so far this year. 3-month Treasury rate at 4.36%, the 2-year Treasury rate at 4.29%, and the 10-year Treasury rate at 4.6%. Moving on to big headlines, current events from the past week, Matt. Obviously, Monday was Inauguration Day, and something tied to that has made waves in the financial media, at least. So over the weekend, President Trump and First Lady Melania Trump launched their own cryptocurrencies known as meme coins. And I think we have to talk about this because I think a lot of people probably saw it, named Trump and Melania. And meme coins, for those that might not be aware, are pretty much digital currencies inspired by internet trends or famous people. That often lack intrinsic value, meaning there's no cash flows behind the scenes backing it up. And at one point, the Trump coin was up something like 50,000% in an extremely short period of time. And there were, people out there saying that they made millions of dollars off of it over just putting a couple $1,000s into it. So I do think some people got very wealthy over the past couple days, but I'm sure there's also a lot of people that piled in and then got the rug pulled out from out of them when it came down off the high and also lost money. So I just thought it was interesting. Thought we should mention it. I think the potential for this stuff is going to keep growing, especially when you see this type of market action in this, where you might have other celebrities, start to come out with their own meme coins or cryptocurrencies to try to emulate something like this.
Yeah, I think I saw something in regards to a hedge fund manager by the name of David Einhorn was assimilating these types of investments to collectibles like art or baseball cards or things kind of along that line. And, his analogy was the value is all in the eye of the beholder, for lack of a better term. And, my 2 cents is, that is no different than going to Vegas and putting some money on red or black on the roulette. My personal opinion. And that needs to be funds that if you were to ever go down any sort of road, whether it's baseball cards, art, or meme coins, you just got to know the type of risk you're taking with that money. Is that a good way of saying it?
Yeah, and it's just that, like we've always talked about in today's day and age, information travels so quickly, so people can get, severely harmed if they see someone made $30 million overnight buying this thing.
Yes.
And people are like, well, I'm going to just do the same thing and buy it, not realizing that it's already, run its course. And next thing you know, it's down 80% the next day.
To prove that point, I saw where there was a speculative trader that saw what happened in one of the meme coins, try to follow it with the second. Not an exaggeration, I think, based upon the post. Person said they put over $800,000 in the second one, the Mrs. coin, and lost it all.
Yeah.
And, you just don't know if that stuff's true or accurate, but It goes to show you that, for every, success story that hit the jackpot, there was a lot of people that didn't.
Yeah, for sure. So just wanted to touch on that briefly because
I think it's good.
It was a popular headline over the weekend. But
Yeah.
Moving on to tweets, articles, and research from this past week. First thing that I had was a tweet from Chamath. We haven't shared anything from him in a while. So this was back on December 28th. And he quote tweeted, or retweeted the following from Kevin Gordon. That's a chart of the top 10 largest stocks in the S&P 500 and the weight that they have within the index. So Jenna will throw...
he must be listening to our podcast. We just talked about that recently.
Yeah. So Jenna will throw both of these up for for viewers on the YouTube page. They'll also be in our show notes. But Kevin initially said on December 23rd, the 10 largest stocks in the S&P 500 now represent 39.9% of the index's market cap. Okay.
Yep.
So this was a chart from Charles Schwab. So this is the largest weighting the top 10 stocks have ever had in the S&P 500.
Mark, why don't you do for our new listeners the difference between a market cap weighted index and a price weighted index like the Dow?
Yeah, so market cap weighted index is simply taking a stock's price, multiplying it by the number of shares out there. That's their market cap, and the larger that number is, the higher the weighting in the index. Mm-hmm. And for example, the S&P 500, the largest companies in the world are Apple, Amazon, Google, Microsoft, Nvidia, Tesla. We can name a couple more. So they carry more weight in the S&P 500 than, say, a company that just went public 5 years ago and has a $50 billion market cap, right? Mm-hmm. So it's not equal. So all of the stocks in the S&P 500 aren't the same weighting.
Proportional to their market cap size.
Correct. And then a price-weighted index like the Dow, for example, it's just based off of the stock's price. So the higher the stock price, the larger percent weight they have in that index. And then there's also some investment products that have equally weighted products, right? So there's a ETF out there. I think it's RSP.
I think it sounds right.
Is the ticker symbol?
Yeah, it's a popular one.
Equally weighted S&P 500 index. So all of the companies in the S&P 500 have the same exact weight. Mm-hmm. So and a lot of times you'll see people compare and contrast the market cap weighted indices to the equal weighted indices. So with that being said, Chamath responded to this by saying this: "This needs to be fixed or it will end in disaster. Why? The average American buys S&P 500 index ETFs in part because Buffett told them to. They were told they would pay very little and get diversification in the 500 best companies on earth to ride out the storms. But as concentrations rise in a very small percentage of stocks, very small percentage of those stocks, the risk doesn't fall. They rise. If the indices don't cap the max percentage of any one stock, you essentially are holding a direct bet on that one company. In this case, see that when you can buy an index of 500 companies, you're really buying 10 companies with 490 others thrown in. If there's any market volatility, the lack of diversification could cause massive impairment. That's okay if you're a quote unquote professional and that's what you are betting on, but most ETF buyers aren't professional stock traders and they will be in for a rude awakening if this isn't addressed.
All right, so let's just address this head on. Let's stop calling it a large cap index and let's call it a mega cap index.
Right.
Let's just call it for what it is.
Yeah.
So 30, 60 seconds, explain what that, when I say mega cap, Mark, for our newer listeners, what does that mean?
So it's based on market capitalization again. So we just talked about what market capitalization is. There's small, well, really, you could go pretty small on this. There's micro, small, mid, large, and then mega, right? Mm-hmm. So small cap companies are typically companies that have a market cap between 2 billion and 10 billion, I think it is.
Sounds about right.
Like that. And then maybe 10 and 15 is mid cap, or 5 and 10 is mid cap. And then larger than that has been large cap. But just over the past couple of years, this new term mega cap has come into play for all of the tech heavyweights that we've seen rise dramatically over the past several years.
Yeah, say the top 20 of the S&P 500.
Right. That's kind of how one way people classify stocks and group them together is if they're a small company, a mid company, a large company, or a mega cap, like your Microsoft, Amazon, Googles of the world, right? So I think he does bring up a good point about diversification and the fact that, your everyday person who's just using ETFs in their retirement account or in their individual non-retirement account just to get broad diversification.
I think they own 500
right,
names.
and I think it's been sold as that. As Chamath was saying with Buffett, it's like just buy the S&P 500 and you'll get broad diversification. Well, it's not as diversified as it once was or it was 10 years ago. So that begs the question, when the next sell-off does happen, which it is inevitable, or the next bear market happens, is that going to be more violent and more fierce because this index or this ETF that tracks the S&P 500 is so top heavy that if those top 10 names fall by 30 to 40%, it's almost as good as...
No place to hide, quote unquote.
Right. The index is going to be down 30 to 40%. So I just thought it was interesting to bring it up. And just wanted to see what your thoughts were on this.
My response, I was going to say some of the points you did, so I won't rediscuss those. The one that you didn't mention is as follows. In the investing world, the more that people do the group herd mentality and invest the same way, those that do something different, i.e. active management, I personally feel are going to have a lot of opportunities. Mm-hmm. So when you have everyone indexing and buying these same type of names, at a certain point, that trade becomes crowded, in my opinion. And for full disclosure, we are active managers. So what I'm saying is bias based upon our investment philosophy. But if you really think about it, if the popularity of indexing, the more someone does that, I think the less efficient, personally, that it becomes. And ultimately, active managers are going to have some good opportunities. And whether they're able to execute on those opportunities is another question. Not all active managers are equal. But that's my point, is the herd mentality tends to not end well on Wall Street.
Yeah, I think my final takeaway from it is this, that, maybe one day that was years and years and years ago, someone can get away with just buying the S&P 500 and feel generally diversified. And I think now it's almost like buying an individual stock. Like you're putting all your eggs in one basket if you're just buying the S&P 500. So I think the takeaway is I might recommend having a couple more ETFs to get you some more diversification than just holding the S&P 500. Because to me, it's starting to get to the point where it's like a single stock risk type of thing.
Well said. Well said.
Second thing I had was a tweet from Mike Zaccardi on December 28th. Jenna will throw this up on the YouTube page. It'll be in our show notes. But he says the S&P 500 forward PE ratio and subsequent 10-year return. So he shares this chart from IBES that shows the forward price to earnings ratio of the S&P 500 and the subsequent 10-year return. So for newer listeners, the price to earnings ratio is just simply taking the price per share and dividing it by the earnings per share. And the larger that number is, the more quote unquote overvalued people feel a certain company is or a certain index
The
is.
more you're paying up for those earnings.
Right. It's just the common numerator and denominator, right? So if the numerator goes up and the denominator stays the same, that's going to have a higher PE ratio. But if the price of the company is going up and their earnings are going up to back up the price increase,
Might be justified.
Correct. So the thing that it seems like Mike wanted to get across here is our current level is right around 22 and a half times forward 12-month earnings. And in the past, when we've been at this level, forward 10-year returns for the S&P 500 have been essentially zero. Okay. So I just thought that this was interesting to point out. Again, I'm not trying to say that this data is wrong or it's going to be different this time, but I think I've heard arguments, and I think people could make pretty good arguments that in this day and age, with the technology that we have available, with the amount of money these companies are making, with how efficient they are, someone could argue that they deserve a higher multiple today versus 20 years ago, and that is just the new normal. The average PE ratio of 14 to 15 times is gone. I think someone could make an argument for that. But I just wanted to share this. I'm not saying it's doom and gloom and stocks are going to do horribly over the next 10 years, even though that's quite the possibility. But it's just interesting that it shouldn't be a surprise to anyone is that the cheaper valuations are of the S&P 500 in this example, the higher the forward returns are in the market. So just thought this was interesting and wanted to see what your thoughts were. And this was this data is going back to 1988. And again, using IBES earnings estimates.
I like that you pointed this out. I think it's a good piece by Mike. I like your point. I'm going to build upon it just for a couple of seconds. When I think back to when I started in the business in the late 90s, and you saw similar levels of stock valuations, and you touched on it, you got to look at the balance sheets of a lot of these mega cap names compared to, say, the top 20 names by market cap in the S&P at 2000 compared to the top 20 names today, just from a balance sheet perspective. I could make the argument that a lot of these mega cap names truly control their destiny from a standpoint that if they feel strong, let's just, this is not a recommendation for or against Microsoft, but Microsoft lately has really been stepping their foot on the pedal from an investment standpoint. I mean, they're talking about having a capital expenditure budget of north of $80 billion a year. And what it's getting at is they have the capacity to do that. And I think it lends into your comment that, not saying it's different this time, but you at least, if someone's making this counter argument that it's going to, we're going to have horrible returns over the next decade, they at least need to justify this now to me. Okay, so tell me how it plays into the fact that these companies have literally hundreds of billions of dollars in liquid cash.
Right.
And go back to 2000, the balance sheets were a disaster. Disaster. So it's not apples to apples. I definitely think it's a data point that needs to be monitored. But I'm gonna throw it out there. If there's a company that is at a high valuation, doesn't have a great balance sheet, if they don't keep up with that growth rate, and the minute the market sniffs that out, you're in for a world of pain.
Right. Yeah, and it's interesting because I think several years ago, Microsoft was kind of, considered like a blue chip name, right? But now with the evolution of technology and the tech spend that they're going to have, it's like, okay, they're kind of moving back into this like growth
mode
name, which deserves a different multiple than when it was considered a blue chip name that wasn't growing as much as the potential it has to grow in the future now with what they're going to be doing. So
well said.
Last thing I had, also a tweet from Mike Zaccardi on January 5th. I think this is we talk about this every year, at least once a year, Matt. And I think this is just our yearly reminder that credit card debt as a share of disposable income is still very low. And this is data from Torsten at Apollo.
Yeah.
So again, we always see credit card debt.
I heard him speak a year ago, by the way.
Oh, yeah?
Yeah.
Yeah, he was good.
He's good.
Yeah.
I like him.
Yeah, he usually puts out good stuff. So, but again, we continually year after year see credit card debt increase, and all forms of debt really increase, but it's never put in the media relative to disposable income. So again, it's, credit card debt as a percentage of disposable income right now is sitting at just over 6%, which isn't screamingly high levels.
Thank you. This is why you listen to the Independent Advisors podcast, because at the end of the day, you're going to get the clickbait. Oh, credit card debt's through the roof, right? The balances. You got to take it relational to something, though.
You do.
Thank you. All right. My first piece is we've talked about more volatility in the stock market being something that we could envision as a general theme here in 2025. So I ran across the next post by Adam Mancini. Was that how you would properly pronounce it?
I would guess, maybe.
Mancini or Mancini?
Mancini.
Okay.
Mancini, yeah.
He said this on January 20th, and it stood out at me, Mark. Those who traded 2016 to 2021 likely remember these news bombs, air quotes, were a trademark figure where the S&P 500 instantly flushes, goes down 50 to 150 points. They usually result in my core setup. The failed breakdown, and we just saw it recently, he said, 1616 to 1620. He's talking about a level in the S&P. So why am I bringing this up? All the changes of the new administration, for better or for worse, I think are going to bring additional market volatility in my mind. In summary, expect it. So as the market reacts to these headlines, we got to remember that a lot of Wall Street trading is, and the initial response is all by computers. You got someone who is inputting that if this news headline comes across the wire, I want the trading to do X, Y, Z. And it takes time for that to really be disseminated. And I just want to throw it out there with some big and bold headlines, again, for better or for worse. Expect some market volatility surrounding that.
Yeah.
Shouldn't be a surprise.
A good example of that was when Trump was signing executive orders, he was answering questions from reporters too. And someone asked him a question about tariffs on Canada and Mexico. And he was like, we're going to, in February, 25% tariffs on Canada and Mexico. Initially, S&P 500 pre-market was down, or futures really was down. And then the market opened up and it was higher. So it's like you can't judge it based on that.
Just expect the volatility. Correct. You're hearing it consistently from us, right? Next piece I think it's going to be great to have a quick roundtable on is a chart that I came across on the Animal Spirits blog on January 22nd by Ben Carlson. And the chart is in relation to time spent in bear markets by decade, Mark. Jenna will put up this chart for our YouTube viewers. This will be in our show notes. And what it shows is U.S. stocks, a percentage of time spent in a bear market by decade since the 1900s, okay? And when you just visually look at this, man, it was tough to be an equity investor from the 1900s through the 1950s, wasn't it?
Yeah, for sure.
Got a lot of challenging times through there.
Yeah.
But then all of a sudden you get to the 60s, roughly about 19% it says of the time you were in a very challenging bear market. In the 70s, 18%. That surprised me because when I started the industry, everyone, all the old timers at the time, 70s were such a hard investment environment. Right. 17% in the 80s, zero goose egg in the 90s. And what's that assimilate with? You had the huge tech innovation. You had the internet. I mean, think about that's what really drove the market during the 90s. The 2000s, you had the hangover effect. You had the housing bubble, the GFC. We spent a third of the 2000s in a bear market. goose egg in the 2010s. And so far here in the 2020s, we're halfway through, already 14%.
Right.
My observations, my first observation is when someone looks at this, they're going to look and say, man, the 2010s, you didn't lose any money. Must have been a great market. We got to remind people that a definition of a bear market is one that doesn't correct from a high of 20%. We got close multiple times, literally within basis points of negating the trend.
Yep.
And I want to throw that out there because you can look at this data in hindsight and say, oh, it was easy peasy to make money in the 2010s. No, it was not. And there were a lot of times where it was tough to hold through some of those periods. I mean, one of the things that stands out at me still is the fourth quarter of 2018.
Yeah.
That was a tough quarter. That quarter alone, the market was down 20% in a quarter. So I just want to throw this out there that that's the first thing. The second thing is that we're already at 14% for the current decade we're in. I'll turn it over to you. Your thoughts and comments.
Yeah, it's interesting. The only thing I have to add is I think someone else could look at this and be like, oh, in the 1960s, it was, the percentage of time spent in bear markets was only 20%. That's not that much. But when you're living through it, it's really hard.
Yeah.
Right?
Yeah. I mean, let's say you retire right at the beginning of that bear market and you are depending upon taking systematic income from your portfolio for your living expenses. Imagine the mental stress that is on retirees.
Yeah, it's something that we call sequence of return risk is, you could be in a situation where you retire and that year we have the worst bear markets in 20, 30 years. It's just, you never know what's going to happen.
Yeah, it's a good piece. All right, my next thing, I think this plays perfectly into it, Mark. Here we go. It's a reminder of what long-term returns actually look like. I brought this piece up, Jenna would know better than me, 5-6 months ago. But it's relevant, especially when I think volatility is going to pick up. Okay? So this is a post I saw by Dividendology on January 21st. And Jenna will put up this illustration for our YouTube viewers. This will definitely be in our show notes. And very simplistically, this is what it shows. It shows what your average static compounding investment calculator projects the value of your investments. In this example, it's utilizing an 8% static compounding rate of return versus the reality of the returns of the S&P index. You might sit there and log into your investment account, and if it is quickly showing you performance information, let's just say your 5 or 10 year average is 8%. We got to realize there's going to be years like 2022 where I can tell you it probably wasn't plus 8%. And the reality is the lower section of this, not the upper section.
Yeah.
And to take it one step further, the statistical chance of the index, stock index, falling around 8, 9, 10% is a low chance when you look at the lens of history. Your thoughts and comments?
Yeah, it's great because it's kind of like, what people, it's one of those things where what people think it should look like and what it actually looks like, what's reality.
Yeah.
So
this is the reality, not the Instagram photo that's perfect, right?
And the reality is that most years, or the majority of years, the market's up. But there are some years where the market's down, and there's some years where the market's really down, right?
Sure.
So I think when people use compound interest calculators online when they're trying to project what is going to be their balance of their accounts in X amount of years, you just have to take that with a grain of salt because it's going to be, it's not going to be this nice compounding line upwards. It's going to be more zigzags and up and downs than what this chart shows. So
we're trying to get you not trained, but get you used to the fact that that's normal.
Yeah, and it's it's again talking about sequence of return risk. You could be someone who's getting into investing for the first time, and you put $10,000 of your hard-earned money to work, and that year the market's down 30%, and you're like, well, this sucks. I'm not going to do this again. And again, it's just having the patience and the time when it comes to this stuff, because someone could get extremely turned off by that, right? Their first experience, their first year in the market, they're down 30%. That's tough.
It is tough. It is tough. I got a bonus piece this week. I had a bonus piece last week, coming with the goods, baby. So my last thing is, I talked about beef prices last week. I noticed coffee the same. Jenna will put up this chart for our YouTube viewers. I got this from Stock Charts, and it's a 10-year chart on the futures price of coffee. I know we all love our coffee, right? You're going to see something very notable. A lot of these underlying commodities have really moved up.
Yeah, eggs again.
And, I think it's a byproduct of, personal opinion. Things might be a little stronger in the economy people are giving it credit for. We have a strong dollar. There could be a lot of reasons as to why this is happening. But I just want to throw it out there that if you're, going to the coffee shop or you're buying coffee at the grocery store and you think that these prices are sticky, well, the underlying commodity price is highly elevated compared to, let's say, last 5 or 10 years.
Right. Exactly. Yeah. Interesting.
Okay. I'll send it back to you, Mark.
All right. Financial planning topic of the week. This is going to be a conversation about a newly created rent versus buy calculator for homes from Nick Majuli. So I just wanted to take this time. It's going to be a little different from what we normally do to highlight this calculator that Nick created, and Nick is with Ritholtz Wealth Management. But he made this tool to help people make the important decision of renting versus buying a home. And the rent versus buy calculator compares the cost of renting for 30 years versus buying a home with a 30-year fixed rate mortgage, because you have to compare apples to apples, right?
Okay.
So the model assumes 3% closing costs, and that rent and home prices grow at the future inflation rate, which you can edit in the calculator.
Okay.
And then what you save by renting is growing by the nominal portfolio growth rate, which you can also edit in the calculator.
Okay.
So in the link in our show notes, you'll be able to find the calculator as well as Nick's explanation on how to use it and how it works. But for those watching on YouTube, we went ahead and created an example to share with you now. So you'll see on the screen here all of the inputs that go into it. So in this example, monthly rent is $2,900. The home price that you're looking at buying is $450,000. Property tax 2.5%, future inflation 2%, down payment 20%, HOA and maintenance fee 1%, portfolio growth 5%. Interest rate on the mortgage, 7%, and insurance cost, 1%. Okay. So in this example, as you can see, if you're watching, the final decision is it makes more sense to rent. So it comes out that the monthly housing cost, the total, is $4,083 when you combine the mortgage payment, property tax, maintenance, or an HOA fee, and insurance. And then it compares it to what the final home value would be if you bought, or what the final portfolio value would be over those 30 years if you invested the savings from renting rather than buying the home. And in this example, the hypothetical portfolio value is just over $1.1 million, and the final hypothetical home value is just over $815,000. So I think we've spent a lot of time talking about it's not always the right move for people to buy a house, and there are certain situations where it makes more sense to rent, and this is one of them. But I think this is something that's been desired from a lot of people, especially younger people that are trying to figure out, hey, should I buy or should I rent? But people are just enamored with the building the equity in the home, where you could be, again,
my parents
renting.
did it. My parents told me to do it.
Yeah, exactly.
My uncle told me to do it.
And they could be investing that difference in the market and potentially making more. So
I have a couple of X factors that I think need to be discussed on this. The first is you're making an assumption that property tax remains at 2.5%. Okay. That could be a lot higher depending upon what's happening in school levies, like a lot of stuff that can affect that. Yeah. So you have an X factor there.
Our property tax where we live has gone up over the past couple of years.
Yeah, and
So,
substantially, right?
yeah.
The next thing is HOA and maintenance. I mean, you're making an assumption. If you buy an older home and there's been people have not stayed on top of those capital improvements, you could have a refresh cycle on the windows, on the HVAC, go down the list that could make it a little more costly, right? And then the elephant in the room is the insurance topic. Can you even get it?
Right.
We got to think about parts of the country right now that are in the news, like Florida and California. There's people that want to get insurance. They can't get it, or if it's offered, they can't afford it. And it's interesting. I was talking with a client of ours that lives in the part of Florida near the Gulf of America. Okay. And this individual I was speaking to lives on one of these outer islands. And the conversation was insurance is not offered. Okay. And this individual is considering selling their property and moving inland to have some more land. They love living where they're at. But it's interesting because whoever's going to buy that property and literally spend 7 figures, Mark, is going to go into it completely self-insuring.
Yeah.
Can you think about, you'd have to have some pretty good wealth to buy a 7-figure property completely self-insuring, right?
Yeah. And it's just one of those things. Obviously, if you're buying, you have a lot more power and you can stay there for as long as you want.
Do what you want.
If you're renting, you're always at, the will of
the
landlord, and they could say, hey, at the end of this lease, or end of this term, you're out.
Yeah.
I need the property for something else.
Yeah. That's why I wrote here, this is a lifestyle decision for me.
Yeah.
It's no different. If I made my decisions as to, say, the cars I have at my household, if I were doing it purely based upon the finances, my wife would not have a gas guzzling full-size SUV, right? The numbers don't make sense.
Right.
But for the lifestyle that we have with three kids,
sports,
everyone's in sports,
taking friends,
it is the lifestyle decision that makes life easier. And I think it comes with the same thing on the house front. I love that you put the numbers behind it, because the newer generations are more apt to have I'm going to rent it philosophy. And I'm not saying that's wrong or it's right. To me, I think at the end of the day, it's nice to put the numbers behind it, but this falls into the category of a lifestyle decision.
Yeah, exactly. And when we were in Florida for Christmas, spending time with my mother-in-law's side of the family, one of Kenzie's cousins lives in California, and they've always rented, right? And he was making a good argument. He was like, I don't want to deal with any of that stuff. Why do I want to deal with insurance and the mortgage and paying the interest rates and all of these things that come with owning a home? He's like, I just want someone else to deal with it. And if that's your mindset, renting's perfectly fine.
No problems.
There's nothing wrong with that.
No problems.
Right? So
yeah, well said.
Well, we'll leave it there for the week. Matt, anything else before we sign off?
Earnings season. Things are going to heat up the next couple of weeks. A bulk of companies in the S&P 500 index are going to be announcing earnings, I'd say, over the next 3 weeks. You think that's fair to say?
Yeah, I think the next 2 weeks are
2
probably
weeks.
the majority.
Heavy.
The heavy.
So if you see some more dramatic movements in an individual name, if I were speculating, they probably reported earnings.
Yep. Okay. Well, we will leave it there for the week. Thanks, everyone, for tuning in and listening to episode 285 of the Independent Advisors podcast. We'll be back with you next week for episode 286.
I'll see you next week, everyone.
Thank you for listening to the Independent Advisors podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.